So let's start. Welcome everyone. Thank you for joining us today. I'm really delighted to be hosting this Xilva webinar. So for those new to us, Xilva provides trusted, independent due diligence for nature-based investments, helping corporate buyers and BS investors turn risk into clarity. And today's session is on from risk to returns, how to structure risk-aware nature-based investments and carbon credit contracts. We have a fantastic panel to unpack this. We have Marissa, carbon removal lead at Meta, Kunrad, CEO and co-founder of CarbonPool, and Jamie, Chief Nature Officer and co-founder of Xilva. And moderating today's session, I'm hugely grateful to welcome Mary Kate, who brings 18 years of experience in environmental markets and forest investments. We couldn't ask for a better guide for this conversation. So Mary Kate, over to you.
Great. Thank you so much, Li-Ling and the Xilva team, to our panelists for joining us, and to all of our audience members for tuning in with us today. My name is Mary Kate Bullen, as Li-Ling said, and I've been working across forest carbon and environmental markets since 2008, and I'm really excited to shepherd our conversation along today. First, I'm going to quickly try and set the scene, then ask our panel to introduce themselves a little bit further, and then we're just going to let the discussion roll. So over the past 12 to 18 months, I think we've seen a really meaningful shift in how the market is diagnosing the finance gap for nature-based projects, or NBS projects. I feel like the conversation has moved from there's just not enough capital to a more sophisticated interrogation of why and what's actually blocking finance from flowing, getting projects up and rolling, and credits in the hands of buyers and eventually retired. We see integrity concerns, additionality debates, market fragmentation, and the challenge of bankability have all come into sharper focus. But one area where we still need much greater clarity is the shared understanding around risk, how we define it, who can bear it, and what it actually takes to manage it well. Earlier this year, we saw a new study published from the Stanford Woods Institute, which put some striking numbers and clarity onto this risk confusion. Researchers surveyed 100 reforestation project developers and 100 corporate buyers about risk, what they worry about, and who they think should be responsible for managing those risks. What I found super interesting about this report was that in nearly every risk category, I believe, the views ranged from rarely a problem to pervasive. And that wasn't just within a group of buyers or developers, or across those groups, but within each group. So some people are saying, absolutely always a risk, never a risk, whether you're a buyer or developer, for every single risk category. And as the lead author, Connor Nolan, put it, when no one can agree on which risks matter and who's responsible, every deal requires reinventing the wheel. That fragmentation has a real cost. It's also kind of frustrating. So as we move into things today, we're going to talk through that gap directly, risk knowledge and how we can bear and manage those risks. We're going to first move from how to identify and categorize NBS risk through to what that can mean for structuring a deal or an investment, onto what insurance can and cannot do to help us. And finally, we're going to look at whether the market, whether all of us are actually learning from what we're doing. Are we improving things with a learning loop that's supported by better data, better structuring, and better outcomes that can reinforce each other? Quick note for all of the audience members today, we do have a Q&A running throughout. We're going to try and leave 15 minutes at the end for questions. So please send your hardest, your best, your most exciting questions. You can drop them in the Q&A box throughout the next 45 minutes. And as Li-Ling said, we're really fortunate today to have 3 people with us who among them cover the full chain of NBS project development experience. I'm going to turn it over to each of them for quick introductions so we can learn a little bit more about the perspectives they're going to be speaking from, and then we'll move on to identifying the risk landscape. So Marissa, let's start with you, please. No worries. We can start maybe with Conrad.
Sure. Hi, I'm Conrad. I'm Conrad Fulik. I'm the CEO and one of the founders of CarbonPool. I'm an insurance person. I've done insurance my whole life. I'm formerly a trained economist, but ran the insurance practice for McKinsey in consulting, and then did a bit of work at BlackRock, running a specialized team there called Financial Market Advisory, also serving insurance clients, and then built out the business for Allianz across Africa, across 54 countries there. So I have a pretty good sense of risk and in the insurance space. And yeah, that's me as an introduction. The last 4 years have really been about talking about building out CarbonPool, which is a carbon insurer in its broadest possible terms, working both with entities like Lloyd's for cash indemnification products, as well as doing things in kind through a regulated entity in Switzerland. So that's me in a nutshell.
Thanks. How about we go to Jamie and we'll finish with Marissa if we can.
Okay, thanks, Mary-Kate. Yeah, real pleasure to be surrounded by such knowledge on the panel. So thank you for joining. I'm co-founder of Xilva. I lead the analyst team here at Xilva, and I act as the gatekeeper of our due diligence methodology. I'm a forester by training, by background, and certainly by passion. And I come here really with 30 years behind me, working in what I often refer to as a translation role between trying to get the corporate world to understand forest management and projects and forest managers to understand the corporate world and finance and what it needs. And that really has been what gave birth to Xilva.
Marissa.
Hi, everyone. I'm Marissa Hamsick. I am the head of carbon removal at Meta. I've been here for about a year, but bring over 20 years of experience working in carbon markets, mostly in nature-based solutions. Prior to here, I was at Chevron for several years and also at BP doing similar roles, and also spent some time running a natural capital initiative at the Nature Conservancy and started my career in Australia at a forestry company that was looking at ways to monetize the carbon, biodiversity, and water benefits of sustainably managed forests. So been around all sides of the market, but most recently really on the buy side, and looking forward to the discussion today.
Great. Thank you all again for joining us today. We got one note that said I'm a little bit hard to hear, so I'm going to switch to talking really loudly. So if anyone, I apologize, we checked it in the sound thing. I thought we were okay. And so if I seem like I'm shouting, someone can go like this and tell me to stop shouting. And I'll switch my sound when we get into the first question. So thanks for bearing with us, folks. Well, great. I'm so excited to now dive into the real topic here. One of the challenges in this market is that risk can almost be pretty amorphous. It's either super general, oh my gosh, there's so many risks, or way specific, where you can get bogged down in every little detail of everything that could go wrong. So to help us develop a more usable understanding of risk, I want to turn to Jamie first. Jamie, you've, as you mentioned, have looked at this as a forester from the ground up on a very diverse range of projects around the world. And now you've built a framework for assessing NBS project risk from the ground up. Can you walk us through how we might categorize and think about the risk landscape?
Yeah, sure. Good question. I mean, it sounds simple, right? Risk is there's sort of an equation people use. Probability, which is the likelihood of something happening, times by impact, which is the consequence of something bad happening. Sounds simple. However, I think there's a reason why that report that you mentioned at the beginning, why there's such disparity between how people see risk. And it's based a lot on what I would refer to as timing and exposure. Firstly, when you're a capital provider, you're funding, you need to think about that timing and exposure in order to determine what type of tool will help me best understand risk, right? Am I the type of capital that I can default directly to certification? It's a certified project, that's enough for me. Ratings, or is my exposure higher and the timing of that, me coming into negotiating with that project at a certain point where I actually need to understand risk a lot deeper. So my exposure's high. So the investors or the buyers need to ask themselves the right tool at the right time. And some of the things that help that is, is it a longer term relationship? Is it a long-term offtake agreement? Is it going to be a very public deal? So there's reputational impacts. It's an untested model. There's new standards, new methodologies involved. Those will all increase the probability and impact, your exposure to it. So the need for deeper due diligence. And to a certain extent, they'll also dictate how risk is calibrated. And that's a word you'll hear me saying throughout this is calibration of risk, not just identification of risks. So I'll give you try to make that a bit real. I don't want to go into each risk category that we look at in Silver Grade, which is our due diligence framework, but I'll choose the ones that I think are more specific to nature-based solutions and perhaps deviate from traditional due diligence, which is a key reason why Silver was brought into the world, is because we felt that there was this missing space of fit for purpose due diligence. So one, I think, that's quite high up on our list is delivery risk. Is there decent access to the right lands? Is there team skills availability? Can the project deliver on this? Why? Because most of these interventions are unproven business models. They're relying on quite a juvenile market, which is the VCM, and unproven business models create more risk. The other is the next one I'd say is very important to us in our framework is theory of change. Sounds very academic, but basically it's absolutely core to NBS. I mean, if you as a project are stating the original forest was lost because of a result of poverty, but nothing in the project is actually dealing with an improvement of livelihoods of local families, then the likelihood of the permanence of that forest that you've restored staying there is very questionable. So that theory of change is a core area of risk for us. And then lastly, I'd mention governance. Is the project appropriately set up to manage corruption in its challenging jurisdiction that it works in? Is it well structured to mitigate commercial risk for the amount of time it's going to take to get to that offtake, for example? And if you allow me, just lastly, I think it's really important interconnectivity. Nature-based solutions can't be assessed and risk can't be understood if you're in silos. And traditional due diligence often looks at it in silos. So financial DD over here, someone does the project design over here. One will inform the other in nature-based solutions, just as in everything in nature is connected. Everything in due diligence of a nature-based project is connected, and that interconnectivity, understanding that interconnectivity will help you understand risks better. I'll leave it there. Thank you, Mary.
That's super helpful. I'm curious, Jamie, with the range of risk you've mentioned, some of these are super technical or very sector specific. How have you been able to see a company looking to either invest or finance a project or engage in a serious transaction with a carbon project take that risk information that you're identifying and making specific for them and translate it into their process of how they assess and manage that, whether that's going through an investment committee process, getting into structuring? I mean, do they talk about theory of change and move forward with theory of change risk?
I think that's probably why we wanted to pull together this panel, because I think we all realize that this is a space that we really need to work on, right? It's not a done deal. So I'd be remiss if I was pretending otherwise. But to give you some examples, if we find red flags, which is a typical term in due diligence of something that really is irremediable, that it doesn't have an immediate solution. It could be something very grave, like we found corruption on the board, or the project boundaries are overlapping with existing projects, right? Or we found funds in someone's current account. That's just moves to an obvious rejection, right? It's not, you don't deal with that risk apart from stepping back from that deal. However, if the project is basically sound, but there's many risks, and there's often more risks with the lack of maturity of a project, then people will start to move towards other mitigation measures. I think where we stand at the moment is the earlier stage projects are finding it very difficult for risks to be acknowledged and dealt with and managed, and that's often a space that's just left to philanthropy to help those earlier stage projects move forward. And we all know there's not enough philanthropic funding out there for nature-based projects, so it's probably, in my view, one of the greatest missed opportunities we have for developing decent pipelines. But where risk is acknowledged and managed and accepted, so it's sort of medium to high risks, then you start to move into price discussions, where price may be a key negotiator in the room, where amount of credit might be determined based on the riskier nature of the project, and then also who owns those risks. So I think that's also an area that we'll be discussing a little bit more later on.
Yeah, absolutely. And you mentioned price, Jamie, and to refer back to that interesting study that came out a couple months ago, another fun fact coming out of that was they found that the buyers were mostly willing and able to pay $60 to $90 for a ton for a credit that they felt was truly risk-free or nearly risk-free. And more than 90% of developers said that they could produce such a credit at that price. So obviously there's some shared room to get there. I think one question would be, where does insurance come in? And Conrad, from your view, the risks that we can address. In our prep call, one of the things that came up was kind of the silver bullet of insurance, and folks wanted to fix a lot of things. Can you maybe help us understand where insurance can play a role and where it can't, so that we could get towards that ironclad, ready to sell credit?
Thank you. Yeah. So first of all, insurance is not a due diligence and doesn't replace a due diligence process. I think the due diligence is extremely important. Insurance comes in after that, and there's a number of things that the market tends to overestimate. And by the market, I'm talking now about both investors, developers, and the insurance actors. And there's some things that the market kind of gets right, and some things that the market tends to get wrong. I'd say the overestimate is fire. Everybody thinks that there's an enormous fire risk. There isn't absolutely a fire risk, but I think the perception of the fire risk tends to be significantly higher than the actual risk itself. That is very insurable. Fire is a very insurable risk, certainly for forests and for carbon projects. I think things where the insurance industry tends to get it right is venture. The venture status of many of these projects is still largely uninsurable. Insurance doesn't cover a startup for its output. That is still for an equity investor to take that risk, a venture investor or a philanthropic investor. Insurance comes in after that. So if you're a new farmer, you will not get insurance. You need at least 5 years of track record and 5 seasons of delivering something before insurance will cover you. And that is what insurance doesn't take that venture risk. The failure rate is simply too high. I'd say what the insurance industry in particular is missing is just the growth potential. Obviously, we're doing this, and a handful of other insurance businesses and startups are engaged in the carbon space. But this is a very interesting high growth piece. And then there's a couple of things that, as we've been working on this now with teams like Xilva and others in modeling it, it's clear that the things that really drive yields and performance delivery into offtakes is drought. And successive seasons, years of drought really kill the ability to deliver the quantities expected into the offtake agreement. And actually, drought is a very insurable thing. So that is something where I think that's really the single biggest risk. I mean, even in things like corn and wheat and soy, the thing that drives even a whole country variance is just rainfall and drought. And then if you localize it, it becomes even more intense. So anyway, that's sort of things that are insurable, things that we're missing, and what we can do better.
Excellent. I guess I've kind of jumped from Jamie and his large focus on due diligence to Connor coming in near the end of the process. Let's go back into the middle if we can, and I'm sure the audience is keen to hear from an important buyer in the market. Marissa, could you share with us a bit about carbon removals program at Meta and how you're starting or how you're continuing to evolve the risk-aware structuring that you are bringing to your looking at opportunities?
Yeah, sure. So, at Meta, we have a carbon removal program that is designed to help us meet our net zero target in 2030. So we have a reductions program, and then the removals come in for the netting piece in advance of that target. And we primarily structure around long-term offtake agreements in both the nature-based and, to a lesser extent, the technology-based space. So most of the portfolio right now is nature-based. And I thought it might be helpful if I sort of talk through how we think about risk from the buyer's perspective, sort of what we see in due diligence, and then how we translate that into contractual elements. Because the risks that Conrad were talking about are really interesting, like environmental risks that can risk delivery. We think about it kind of from a number of different perspectives that I'll sort of talk through now. From a due diligence perspective, a lot of what we are looking at is some of what Jamie mentioned. The cost of entry is just working with a great management team that has a lot of technical expertise, that understands carbon projects, and has a lot of great local relevant expertise. That's kind of the first thing, just to mitigate any kind of high level operational risk, which is operating in a particular environment. From there, we kind of move to more of the technical risks. If the initial risks are, kind of past our initial due diligence, And for us, what that typically looks like is we're a large organization that's used to doing large, power purchase agreements and kind of take some of our cues from the renewable energy markets and are very focused on delivery risk. And particularly in the nature-based space, often that is about expansion and scale-up risks. Projects often come to us in a very early stage and have pilots that are maybe in the dozens or lower hundreds of hectares or acreage and need to scale up to thousands of hectares to deliver the kinds of credits and volumes that we're looking for, that we look for collectively in buyers associations like the Symbiosis Coalition. So we're really trying to understand how quickly can an organization scale up. And then what does that mean for delivery risk? Some of that can be technical analysis around, do we believe the sequestration rates? We've spent a lot of time also on things like discounts for uncertainty, for leakage. How is the baseline established? Are you using dynamic baselines? And then ultimately what we're trying to figure out is, based on the project design, how much of what that project can deliver are you contractually obligated for? Do we believe that the counterparty can meet those contractual obligations? And so the way we kind of translate that into how we think about contracting is we rely a lot on milestone-based contracts that have various exit triggers or different remedies at different points along the development process. Again, these projects are often coming to us really early stage. And so there will be different triggers along the way or milestones along the forward timeline until first issuance or first registration, where certain scale-up operations, planting, or other things related to like government permits or community engagement plans need to be met along the way. And if those start to fall behind, there's different remedies, including, ultimately exit. And something else that I think is really important to mention and is a massive way that we manage risk, but can be challenging for developers and sort of is maybe the flip side of some of the insurance and what Conrad was talking about might be interesting to discuss these dynamics, is what we refer to as security, which is where we require counterparties to make some kind of financial commitment against the delivery that they say they are able to deliver. So, for example, the risk we're trying to mitigate against is when we enter into an offtake agreement with someone, we are then reserving that capital to pay that agreement. If those credits don't deliver over time, that means we have to go out to the market at a later date, likely at a higher price, and procure the credits at that time more on the spot market, and that has a financial impact to us. And so what we are trying to mitigate against with counterparties is, if there's an under delivery event, there are different remedies in the contract for that under delivery. It could be replacement credits, it could be extending timelines for various reasons, or it could be some kind of financial damage. And so we require counterparties to have the means by which to pay that financial damage if the contract reaches that point. That could be a letter of credit or some kind of parent guarantee. And we have found that this is often kind of challenging because we're working with small project developers or NGOs. But that is one kind of critical mechanism that is probably worth mentioning and is newer to a lot of developers that we talk to, but is starting to be expected from a number of more sophisticated buyers.
Yeah, absolutely. I'm sure that's going to garner some questions and reactions from the Q&A as well, as folks will want to understand that more. Mercy, you did mention the Symbiosis Coalition, and I think they're one thing that's popped out to me, as well as more visibility of groups like, say, Rubicon, who are almost playing an aggregation role to bring pools of credits to buyers. Could you maybe talk a little bit about how these more collective, in the case of, or collaborative, symbiosis, collective in an aggregator sense, opportunities are changing the way that individual buyers like Meta can interact with the market?
Yeah, so from a couple of perspectives, there's some buyers in the market who have very large teams, but most buyers in the market, the teams are a lot smaller than you would think. Even at Meta, it's a very small team. And so the sort of advent or creation of these buyers coalitions, I think serves two primary purposes. One is to create a demand signal for the market through these kind of advanced market commitments or long-term offtake structures, where we're pooling demand, we are setting a quality bar we are public with that and very transparent about the expectations of those buyers, and then willing to enter into long-term offtake agreements based on those quality criteria. And the intent there is that these projects then become bankable, that by having long-term offtakes in place, suppliers can go to the market and secure financing. Oftentimes, these large buyers, Meta included, are not investors. We don't typically do prepayment, but we are willing to pay on delivery, and that contract can be bankable to go get the financing required. But more on the buy side for us, it really helps spread the due diligence costs and the due diligence risks by kind of having the wisdom of the crowd, working with your peers on, again, setting that quality bar, but also as projects come through the pipeline, being able to collectively diligence those projects. There's a cost sharing with that. There's a time savings with that. Again, we're often small teams. But there's also just the collective wisdom of assessing different project risks in geographies we're often not familiar with, developers we've never worked with before. So it's very helpful from that perspective as well. And maybe the final point is that for sellers, it's trying times, as we know. Businesses are always going through cycles. And from a seller's perspective, if you are offering your project to more of a buyer's coalition, if one individual buyer's appetite changes, there's still other buyers sort of in that group that can backfill as companies go through different cycles. So I think it's helpful from that perspective as well.
Absolutely. I'd love to hear, Jamie or Conrad, any reactions to some of what Marissa shared. I mean, there's some really big things here that project developers and sponsor side need to come to terms with to be able to get towards that view of bankability, to get those offtakes if that's what they're pursuing and the financial model they're looking for. I'd love to hear thoughts from you about it. Conrad?
My immediate reaction is refinancing. So one of the things that when I see we now see a lot of these projects coming in, and there is basically everybody still trying to, and I see the question even in the Q&A, many of these projects are still trying to sort of deliver returns to an equity investor for extended periods of time. Really, that equity piece is needed to get the project off the ground and for it to start delivering its first measured carbon credits. Once once it's planted and it's all there, at that point the risks become much more natural risks, and you can refinance the whole thing. At that point, you can get insurance for yield because you have a track record. You can get insurance for yield, which means you can go to a bank, and the combination of the offtake agreement that guarantees the price and insurance that guarantees the volume, those two, the P times Q guarantees your revenue. And now you can actually refinance your whole equity with a loan at a much lower cost of capital. And then you can either reuse that equity into a second project, or you can pay it back to your investors. But I've yet to see a spreadsheet from a project developer that has refinancing in year 7. There's just nothing yet, and that's what happens in every single other sort of infrastructure piece. Is there's a refinancing once the whole thing's up and running, and there's now somebody who's buying the energy or whatever it is that project is making, and then it gets refinanced. It's much lower risk and therefore much lower return on capital requirement, and that's insurable. And so that's really what I would encourage everybody to think through, which is, take the equity for 3, 4, 5, 6, 7 years, refinance once you start to make your first carbon credits, and change that from 100% equity philanthropic into 80% debt or whatever you can get.
Yeah, I think the way you're talking about it addresses some of the kind of different perspective I bring from a buyer like Meta. I've come from more of a side of real assets investments where we are trying to blend carbon revenues in with things and increasingly looking directly at dedicated MBS opportunities. And it seems to me that one of the kind of gaps in the market is there's a handful of specialist equity investors and some debt investors who are really trying to bring skill sets to the table to help support developers and having a greater likelihood of success by mitigating risks. And it's funny to me to hear milestones that are kind of like off ramps for exit, because in my world, milestones are all about the next reward and the progress of those projects. So it really is different mentalities, right? And I think Conrad's raised a really important thing, that there's multiple ways of looking at finance. And I think it's, Symbiosis and the buyers who are really trying to help projects get to true bankability through scaled offtake agreements. There's still other pieces to that finance. There's what it took to get to be able to survive the due diligence and prove out your risk management to have the security. There's that piece. And there is also this long tail of these projects, which we have a question I think we can circle back to in the end, as Conrad mentioned. We're talking 30, 50 years. So you've got early development, you've got the scaling phase that Marissa talked about, and then you have keeping that credit a real durable credit over time. And all of those can fit with different finance. And we don't have to be wedded to one approach for the whole life of the project. But that's also challenging, because I think a lot of project developers don't start these companies because they're finance experts. They start them because they've got an in on how to restore or protect nature. So it's really a marriage of skill sets here. I think that's also needed. With that, I think maybe we'll kind of move into a little bit deeper look at insurance, sticking with Conrad, if that's okay. You mentioned you started getting into formulas. We had P times Q. I'm wondering if you can take a step back for us a little bit, Conrad, and tell us what type of information you need about MBS projects so that you can measure the potential risk and think about products that are suitable for MBS projects today. Oh, you're muted.
Sorry. So we today I've had 4 client discussions or developer discussions. So we're in the middle of having an awful lot of discussions with people. I'd say there's 3 basic types of things that you can insure. You can, for nature-based solutions projects, you can insure planting risks. That's really very early stage. It's almost always going to be parametric. The capacity certainly exists, and that basically means, if there's a drought, mainly, you can get repaid for your planting costs. The second one is yield, like crop insurance, performance insurance. Super important once the project is running. It's what unlocks the refinancing. I think people think it unlocks the financing. No, the financing has to be equity. I mean, it's possible, but it's more difficult. But really, crop insurance unlocks refinancing, or yield insurance unlocks refinancing. And then there's permanence, reversal risk. And one of the things that we've been doing at CarbonPool is to work with Vera to basically do insurance instead of a buffer pool contribution, which is, replaces the buffer pool contribution, which can be quite onerous for some projects, with an insurance product, which in some cases is significantly more cost effective for them, certainly in the short run. I'd say the real big issues tends to be around discussions around what's insurable, what's not insurable, things like climate, fire, theft, illegal logging. I mean, these are largely insurable. Things like political risks and credit risks in early stage, back to venture, largely uninsurable. Political risk, partially insurable, but insurance industry doesn't like to take sort of systemic risk. You don't want to have exposure to Brazil saying we're not going to let anybody take carbon credits out. There's just too much accumulation. Then there's things that start to get really difficult. So there's many projects with lots of stakeholders involved, and ensuring stakeholder enrollment as a sort of continuity of delivering those carbon credits is just basically not feasible. And then what's not insurable, I mean, it's illegal in most jurisdictions, is willful destruction. And that's where we sort of sometimes run into sort of banging heads with the registries who cover willful destruction, but that's criminal, and you're not allowed to insure crimes in most jurisdictions. So there is, those are sort of things that are insurable and not insurable. I'd say some of the other sort of interesting points is there's a lot of discussion about remote sensing. Yeah, remote sensing helps, but really what insurance indemnification is about is actual measurement, not something approximate that you can go to court for and then end up in a really protracted court discussion around it was there, it was not there. So we need measurable things. Projects that are not measurable get very difficult. So yeah, you want measurability, and accidental causes, whether they're avoidable or unavoidable, which just be accidental. People, you don't want to have the moral hazard there. I'd say the one thing that I speaking more as an economist and having spoken to lots of these academics on this stuff, that I think is a bit misguided is I think we will be short carbon removals for as long as most of us on this call live. If we would have a meaningful spot market in equilibrium, then we wouldn't have a net zero problem because Meta and everybody could just go to the spot market and buy the amount of carbon removals they want. But obviously we can't do that. So we need to lock into these long-term offtake agreements. And what that really means, and I was at a Carbon Direct event the other day, is that basically 2030s or everything's been bought. So everything that's planned to be delivered for 2030 has been bought, locked into some offtake agreement. There is no spot market. I mean, there is some transactions. Absolutely, people confuse transactions with the existence of a market. Transaction doesn't make a market. A market is it clears. There's enough supply for the demand, and when that doesn't clear, there's no market. And I think this is one of the challenges of insurance in cash, which is one of the things we've been doing in CarbonPool, is try to do in-kind insurance to sort of convert carbon into a currency unit, as it were. That has lots of other problems, which I won't go into here, but that avoids that spot market problem of trying to convert $50 million into carbon removals in 2030. I mean, good luck. I mean, yeah, you can get another offtake agreement, but it will be difficult to spend that in the spot market. So that's where we stand on insurance and what works and what doesn't.
Marissa, how does that work or not for you? I don't know if you're able to kind of give an example where you've seen insurance provide a solution that's able to play a key role for you to be able to go forward, or if there's still something you're looking for.
And so I've seen insurance discussed in commercial negotiations about who should bear what risk. Getting to an insurance product that works, that solves the correct risk that Meta at least is trying to solve for, and what can be borne by which party has been the more challenging part. So going back to the security risk, and well, it's really delivery risk, and then what we're trying to mitigate against is in the event that that delivery does not occur, and there's financial damages that need to be paid because there's no other mitigation remedy, the risk that that counterparty is now out of business or cannot pay that pre-negotiated damages, which would, essentially compensate Meta for having to go out to the market in this presumably rising price environment in, 2030, 2035 when the under delivery occurs. So it's, from my understanding, very hard, to make an actuarial table to mitigate against a risk of a small counterparty potentially not being able to pay something. That is really down kind of the food chain of risks. What we have kind of way we've been thinking about it is, well, what would cause that under delivery? Is it the kinds of things that are insurable that Conrad is talking about? There was a fire, there was a reversal event, there was a drought, the trees didn't grow very well. If so, that insurance might be most appropriately taken out by the project developer, not by the buyer. And then the buyer, to your point earlier, Mary Kate, about buyers requiring certain, quality thresholds or risk management, perhaps willing to pay a higher price to get a lower risk product, is a conversation we could then have, is what is the cost of building those kind of risk mitigants into your project design? Mm-hmm. That might be a package that we could discuss. Where it gets more complicated is the project developer underperforming? Did they oversell the relationships with the local communities? Is the expansion plan not going accordingly? And therefore that is what's leading to underdelivery. That is much harder, I imagine, to ensure, and where due diligence really comes into play, but where we really won't know for 5 or 10 years from projects that we're executing against today how real those risks are, or if we did our job in diligence and have the best project developers out there. Did I characterize that fairly, Conrad?
Apologies from my side. I had a full power outage here, so I've dialed in by phone, so apologies for that. Some things are risks you did not anticipate, but probably should have, right? And I guess this is a good backup method. So have we still got Conrad there? I don't know if you wanted to reply back to Marissa.
I fully agree. Sorry, I gave the thumbs up on the video, but I guess you're on such a small screen you can't see that anymore. No, I think there is definitely things where the insurance industry has been very slow here, right? And I can only apologize for this. It has been a very small market until recently, and so the insurance is just a slow industry. We don't react very innovatively and quickly. But I certainly think there is quite a lot of momentum right now. The large brokers all have teams. Lloyd's is quite engaged. Some of the big insurers are getting involved. And there's a number of interesting startups. So I think there is now certainly an ability to have these insurance risk conversations and to have solutions being designed. But they do need to be at scale. I mean, there is many of these projects are still very small, and then design. This is not car insurance. It's not a retail product. These are quite difficult things to do, especially the first time. And so if it's not a sort of project in the millions, it becomes very difficult to sort of create the brain time to structure an insurance product in a market where nobody has direct access. It takes a lot of time and effort, and that you can really, unfortunately, at this point, only do for the larger initiatives.
Great, thank you. Okay, I'm just being mindful of time. I promised everyone at 15 minutes we'd be getting to Q&A. I'm going to push that back so we can get to our learning loop ones, because this was something I think everybody was kind of excited about as we talked on our prep call. As we are structuring is learning from past experience. You can joke a lawyer's seen a deal once with a 5-page contract. By 10 years later, the same deal would have a 20-page contract, right? It's just, is this really just turning into more on black and white about how we structure, or are we fundamentally shifting risk from just being identified to managed? And does that management, are we clarifying who's responsible for risk? Are we thinking about equitable risk sharing? Jamie, I'm curious from your view, working with a wide range of projects and developers around the world, could you give us a couple of examples where you saw lessons learned, whether hard or soft lessons you've learned, have helped actually mitigate the risk so that the underlying risk itself is changed or mitigated in a way that Marissa's going to worry about it a lot less, and Conrad's hopefully not even going to have to be involved on that risk?
Yeah, I think insurance will definitely need to get more involved, but there is a large argument in NBS for us to really understand risk. So it's not just identification of risk, right? I mean, investability, it's not the avoidance of risk or an absence of risk. It's a function of whether that risk has been properly priced, whether it's been properly structured, managed, or properly transferred and owned, right? So risk identification alone and then a black and white response to that is not always the most helpful thing. And in NBS, we've got a long journey to go before we can get to the black and white solutions that everybody is clamoring for, right? We need to understand risk better. So DD, due diligence, has a role to play there, right? We not only delivering a sort of judgment of high, low risk, but actually being part of shaping how that risk is managed, how it's priced, structured, and owned. So we need to rethink risk function there from binary to turning it into a source of insight and competitive advantage. And how we've achieved that, some of the best examples I can put forward were achieved through what we call a risk ledger. So one of the major outputs of the due diligence process in the report you give back to the client, to the investor, to the buyer, is a risk ledger. It identifies all of those risks, how they're currently being mitigated or not by the project, and how they should be being mitigated into the future. And it calibrates those risks within the exposure that the client has to that. So the risk exists, natural hazard risks exist, but has it been decreased by the mitigation the project's involved, and does the exposure to that risk increase over time because of the ticket size or the time span of that engagement? So we create a risk ledger. And I only explain that because you need to understand that to understand the examples I'm about to give Mary Kate. And that's so one was where that risk ledger raised the risk, and one of the risks we raised was in an IFM project, right? And there was an expectation on the client side that there was going to be co-benefits around this. But then when it got down to it and you break down the finances, and you can see that the risk is there that actually those co-benefits were not going to be delivered because of the operational costs and everything involved to the expectation level of the client. So you raise it as a risk. The good outcome there was that actually ultimately what they did was to raise the price, the carbon price. So the the client's happy because their co-benefits that's very important to their metrics was getting covered, and and of course the project's happy, right? They're getting a better price on their carbon, and on the ground you're creating far deeper interests, right? So without that risk being identified, that would not have resulted in that good outcome. Another example of that risk ledger was we're involved in a project in India where we raised the risk around drought and it really not delivering, therefore the growth that you should see in the carbon sequestration and therefore the tons and the credits. And that became, that was eventually the risk ledger was turned into a performance milestone for release of funds. So the risk number one being drought, release of funds allowed that project to improve its drought management, its irrigation, construction of wells, etc., which then guaranteed the growth that it was actually aiming for, and therefore the carbon credits that it was going to generate. So that was an example of risk going from a sort of black and white identification process, flipping into performance milestone tracker for the projects. I mean, there's even been cases where, you know, you might think one of the most challenging risks that we find is overestimations of carbon, right? There's some incorrect application of allometric equations, but even that, it sounds a little bit counterintuitive, Mary Kate, but because that's the very thing that VCM should be doing well, right? But when we find it, what it actually does is that it allows the project to correct that before those credits are hitting the market, before it's creating a reputational issue, and before it implodes around. So even there, where an issue that's absolutely core to VCM has been found to have a miscalculation or incorrectly applied allometric equations, for example, even there, by finding that risk, you can deal with it, and you can deal with it before it gets completely out of hand for everybody involved. So it's many cases, I think, but I think to get to those great cases, you have to have the mindset to use due diligence as that learning exercise.
That's really illustrative, those examples, Jamie. Thank you so much. And what struck me about it is I think the way you're discussing the risk ledger is truly giving everyone a commonality of information, transparency, and shared understanding around the nature of risk issues, the potential for ownership, the potential for pricing, and for kind of residual mitigations as needed. And it seems to me that that type of concrete information and it's able to resonate across industries. It makes sense to insurers. It makes sense to corporates who have huge risk teams who've been having risk ledgers and systems for decades. It's really bringing things into a common language and understanding to move forward. Speaking of moving forward, because we do have some great audience questions, which we appreciate folks engaging with us there. I'm going to go ahead and flip us into the Q&A at this point. For panelists that can see the questions, if there is something you definitely want to answer, be ready for that with the next one. But for now, I'm going to kind of combine a couple of questions which deal with maybe some of the stickier issues and projects. We had one question, which is from someone who's anonymous, which is great. For projects where land tenure is still being formalized, what's the earliest stage at which a structured offtake or pre-purchase agreement becomes viable? And how do you think about minimum conditions to require before signing any sort of engagement? And finally, does sovereign soft support, such as a ministerial support letter or similar, change your pricing or deal structure? I'm going to combine that with a question which is kind of adjacent, which was for Jamie around, have you been diligencing projects in conflict zones? So to kind of go to the far side of land tenure risk and concerns. I'd love to just hear some reflections, maybe starting with you, Jamie, about the social land tenure conflict status, how you think about sovereign fittings, and then maybe we'll bounce it towards Marissa if she'd like to answer about how early you could think about an offtake.
Yeah, sure. I mean, just those questions alone, we could have an hour-long webinar on, right? The social side of things. If there was this one thing that we could fix and really should be fixed is secure land tenure, especially for community groups. I mean, if you look at over 50% of the land held under customary tenure and managed and communal land, particularly in Africa, right? So that's 50% of our potential pipeline that often companies are just not able to access very well because it creates insecurities when land tenure is not there. Not just from a commercial side, but it of course creates, increases precarity for the indigenous peoples and local communities themselves. It's a huge barrier to project design, permanence. It's like the one issue that whenever there's land tenure comes up in pretty much every, especially community managed projects. And we're in the tropics, right? 24% of carbon stored around the world's tropical forests above ground, not even counting soil. That's 24% is stored in those forests that's in collectively managed hands. So we have to solve this one. And it comes up in, I would say, every single due diligence we do. Whether it can be structured in an offtake, I'll leave that question to Marissa and Meta, but there it often depends on the risk appetite of the buyer as to how willing they are to accept those uncertainties around land tenure, or for how long. Often it's a time issue, right? So if my offtake doesn't happen until 2028, we've got a few years for the project to try to fix this and grow. But that it really is a risk appetite issue, just is that question around war zones. Yes, we have done project assessments in conflict zones, managing how the project views themselves in that regard and whether they're well structured in their governance and team and their mitigation measures around what to do in conflict cases is really key. But there it's actually quite rare because before you even get to assessing that, you've already gone through that barrier of risk averse companies. Just, they're not allowed to deal with projects in some of those zones, even if they wanted to.
Absolutely. Marissa?
Yeah, so jumping in, it's a really interesting question, and it's something we've dealt with. And the way that I would frame it is, at least for, large sophisticated buyers, one of the learnings we've had over the past couple of years of trying to get these nature-based projects, high quality nature-based projects off the ground and at scale, is that we really need projects that are offtake ready. And there's a number of things that need to be true for a project really to be ready to enter into a sophisticated contract with a buyer who is ready to commit funds and pay on delivery and is not looking to take a lot of the earlier stage risks where grant funding, working with NGOs, venture capital, or other kinds of risk appetite might be more appropriate. And for a project that hasn't even resolved kind of the land tenure issues, government relations, working with communities, that would be something that we would consider not ready for an offtake yet. And that's partially because kind of what Jamie was talking about, just the fundamentals aren't in place yet in terms of what is your expansion plan, what communities are you working with, and critically, like who owns the carbon rights and what is the benefit sharing plan. One of the biggest risks that we're concerned about, other than the climate related risks, is the carbon accounting correct, and are we actually having a benefit to the climate for which we can make a credible claim against this removal, is community and social risks, where communities feel disenfranchised, or there might be a risk that Meta or other buyers are somehow doing something inappropriate in a local jurisdiction because the community and social engagement and the benefit sharing isn't completely buttoned up and very transparent. And that's just a project from our perspective those are risks we would not be prepared, to take on yet. Or at all until some of that is resolved. But to the final point of the question about the soft sovereign support, that is helpful, and that's always something we're looking for, is understanding what are the laws and regulations in which this project is being developed. Are there any taxes or contributions or anything related to corresponding adjustments that we need to understand in how we're going to engage with the government? So that is helpful, but in a case like that, you would look to the government support to help resolve whatever the land tenure issues are, to make sure that is incredibly clear before we would want to advance a project.
Yeah, well understood. That's great. We have a number of great questions. I'm trying to kind of think through the ones that are most linked to our risk topic here, because some are, as Jamie said before, things we could have whole webinars about other things. One of them importantly being for projects that aren't ready for offtake, where do we get the finance? As well as the item we mentioned earlier about duration of financing and sequencing through different types of financing over a project's multi-decade life cycle. I'm hesitant to go straight back to Marissa again, but I think we can tackle this as a joint question. It was tagged for her around, are there any lessons we can use from the forest industry to nature-based carbon projects where it relates to return on investment, tenure, and long-term risks? And what that really makes me think about is the opportunity to think about the bankability term. How investable is a project that maybe has multiple revenue streams, that has the security of, say, a real asset of land, for example, other things that can de-risk the financing from just being dependent on credit delivery itself and the number and volume and quality of those credits and what the market wants to price them at the time they're delivered. You know, that is something to me that has been a really powerful thing to think about, unlocking different types of capital to flow into nature-based solutions. Conrad or Jamie, what do you think about that from a way we're able to think about risks when it comes to getting capital flowing to these projects? Are there learnings from the forest industry or from other types of investment for climate solutions?
Yeah, I go quickly, Conrad. I mean, yes, there are learnings, and actually it becomes a bit of a flag when you see that those learnings are not getting integrated into new carbon projects, right? There's a lot of new energy coming into this space, which is fantastic, but there's also a lot to be learnt from other sectors, from forestry, from agriculture. For example, if you're trying to scale a very ambitious reforestation project, look at how ag has done that through extension services. What's the number of outreach officers that they really need to scale this type of project, for example? And often that's something that's missing, and it flags a risk that says, okay, there are actually models out there. This isn't completely new, and the carbon project world can and should be learning from them. And then lastly, just to close, I would say, you know, the good thing is that we are starting to slowly better understand those risks, and we will learn from others, just as we're starting to mix here. There's foresters on this call, there's finance experts, there's insurance experts. That mixing is absolutely key to get comfortable with risk, right? To embrace it and to understand what those mitigation pathways are for risk over time. Conrad.
Yeah, I would just again go back to the financing discussion. I mean, industrial forestry is obviously a pretty big industry globally. There is some absolutely massive players in that, Manulife Timberland, who is one that we work with quite a lot, who obviously fund essentially through types of bonds funded from people's pension monies, and that's basically what's invested in all of these industrial forests. You need to get to that point where it becomes a machine. That equity risk is that first 5 years. After that, you can refinance. I'd say the one big difference between industrial forestry and afforestation type of projects here is timing. I think when you're working in industrial forestry, it's a global market. You can, and your trees do grow more or less every single year, but you have a standing stock, and so you have a choice every single season because there's a spot market. How much do I harvest, and at what price do I sell that? And so you can optimize it really on a year-to-year basis. Energy prices are actually a huge contributor because it's one of the waste products of industrial forestry in terms of deciding how much you harvest or not. Whereas in afforestation type, nature-based solution, afforestation type projects, you're locked into an offtake with sort of minimum deliveries, quite specific according to time, and so you have less flexibility in the carbon world than you do in the industrial forestry world. But for that financing part, I mean, really, I know we're very early stage with all of these afforestation projects, but right now, some of them have now been running for 5-10 years. That should all be being refinanced into forms of, pretty high debt to equity mixes.
Yeah, absolutely. Unfortunately, we're just about at our hour mark. I want to share just a couple of quick reflections before I ask the panelists one very fast final question to close us out. And that is that for a conversation around risk, like this has me feeling very optimistic. Risk can be a challenging topic. If you're not a risk person, I think it makes people shudder a little bit, not get all jammed up and excited to dive in deeper. But this is an optimistic discussion. We're seeing how from due diligence through to relationship building to collaborative learning to bringing different types of actors together. We didn't dive into it, but it got mentioned a few times, philanthropic or catalytic capital coming in early to complement and help demonstrate before we can scale. These are really all things that are getting better because we see better due diligence, smarter contract design. Insurance market is finding its footing for nature-based solutions, and buyers are learning and sharing together rather than keeping information siloed. The challenge now, I think, is to get more of the market to engage with that type of sophistication and to reinforce this learning loop that we're starting to see as we move forward. I've asked the team to be really practical today, and I think everyone's done a great job sharing concrete, practical things. So I want to appreciate Marissa, Conrad, and Jamie for sharing those practical learnings and experiences. But we're going to end on something a little bit more whimsical and not so practical. If you had your magic wand and you could eliminate one risk from all nature-based solutions projects forevermore, what would you get rid of? I think Jamie actually mentioned his.
Yeah, I've mentioned mine, I think, and that's secure land tenure for community groups. It's a real barrier. It's a huge challenge for them. It impacts their precarity and it stops projects moving forward. And as a global movement, we need to figure out how to solve that.
Well, as an anthropologist in my early days, I appreciate that perspective, and it's one I think we can bring some skills to help support. Conrad, what about you? Magic wand, what would you get rid of?
Permanent risk.
Okay. That what you put there gets to stay lastable forever, and we don't have to worry about quantifying that risk. Okay,
Exactly.
Great. Love that. Marissa, what about you?
Yeah, Conrad took mine. I was going to say permanence risk, and the corollary to that is like standards risk, which we didn't talk about at all today. But the other side of this equation is the claims that you can make once you have procured these things, and the headwinds that we have around nature-based removals versus other forms of removals often comes back to permanence risk. So I'm going to say standards risk.
Yeah, great. Well, good news is that while we don't have magic wands, we do have a field full of experts who are all learning and collaborating day on day. So I am feeling very hopeful and positive that we'll be seeing more of these risks better managed and equitably shared and better priced going forward, so we can just get what we want, which is good carbon credits flowing from projects on the ground. Thank you to the audience for joining. And again, thank you to Xilva for bringing us together, and to Jamie, Conrad, and Marissa for sharing from their experience today. Over to you, Li-Ling.
Yeah, thank you so much. Huge thank you also to Mary-Kate, to you for moderating a great discussion today. And again, thank you, Marissa, Conrad, and Jamie for sharing your insights and expertise so generously today. Thank you to everyone for joining us and for the great questions that came through. And if you'd like to continue the conversation, please do get in touch. So until next time, take care and thank you again. Bye.
Thank